Okay, well, we might start now. Thank you to everybody for dialing in. My name's Michael Houghton from Lucerne Investment Partners, part of the team that look after the Lucerne Alternative Investments Fund, of which Sam Berridge is the portfolio manager of one of our underlying investments, the Perennial Global Resources Trust. As you would have seen from the invitation, there's a couple of key themes that are driving commodities in general, and in particular, there's also a couple of underlying themes that are really pushing some commodity prices. The overall macroeconomic settings are pretty strong and supportive of that ongoing, and Sam's going to talk to that. Lucerne itself believes that commodities have the potential to be a very long-term and well-supported market theme, and we're very confident with Perennial and the team there, and in particular Sam, in identifying those opportunities and being able to continue to position their fund and therefore our underlying investments well. But I'm going to hand over to Sam and introduce him now and allow him to talk through his presentation, which he will share with us, and questions are available. Just type them in and we will moderate the question and answer session at the end of Sam's presentation. And over to you, Sam. Thank you.
Thank you very much, Michael, and thank you very much to Michael, the rest, and Jerome Lander, and the rest of the Lucerne team for, I suppose, sharing the vision on resources as a class that was looking quite compelling from an asset allocation point of view back, probably late 2019. And certainly, were instrumental in helping set this fund up and get it up and running. And it's been very pleasing that both myself as an investor and also Lucerne clients have done quite well out of it over the last 11 months or so. So on to the presentation. We're here to talk about resources, and just to follow on from the point about from an asset allocation point of view. We see, the outlook for resources as being quite bullish in an absolute sense, but certainly in a relative sense. And this chart you've got in front of you now is a relative chart. You need to keep that in mind. And so, this massive underperformance of resources that you've seen, over the last, decade or so, or decade and a half, is a function of two things. One, resources in absolute terms have been falling in price, but also the S&P 500 has been on an absolute tear. So combine those things together to get to where we are today. And this sort of little pull-out chart that you can see, just above there, that was updated as at the end of January. So, whilst we have had a bit of an uptick in the space, and the S&P 500 is starting to wobble just a little bit, it is still inconsequential relative to where this ratio has been and can get to, particularly if inflation starts to take hold. But I'll touch on that a little bit more in a second. But whilst this talk is about commodities in general, I think it's very important to realise that this exists within broader share market, within the broader share market and broader share market themes, and certainly things are looking a little bit frothy overall. This chart you see on the right here is the cumulative returns of profitable companies relative to companies which are loss-making. And quite intuitively, over time, it's being invested in the profitable companies will see you outperform. But that's not what's been happening at the moment. That sharp tick down in the ratio over the last year and a half just highlights that it is the unprofitable companies which have been outperforming, and certainly it does draw comparisons with the dot-com boom and bust, quite strongly. Now, if there is a big market drawdown at some point, certainly, the miners and commodity sectors won't be immune from that, because there'll be a bit of a liquidity suck, but they should be, they're on a much stronger foundation than some of these other sectors, because they have exposure to a hard asset class or hard assets, and they're something that should do reasonably well in a period of inflation should it return. So yeah, whilst they might come down, they should outperform on a relative basis, and they should come out of it much harder than or much better than other sectors. But just to sort of drill down on a little bit of financial theory here, and I appreciate that I'm not Margot Robbie. So for those of you that have seen The Big Short, I'm going to try and keep this as short as possible, because I'm sure I can't hold your attention like she did in that movie. But what we've had over the last 10 years or 10 to 15 years is a period of falling rates, and falling rates means falling discount rates, or the rate at which you apply to future cash flows. And what I mean by that is, like, one means of valuing a company is the sum of forward cash flows. So these charts you've got in front of you at the moment, we've just got a boring old sort of reasonably reliable industrial company, stable cash flows, but not growing that much, not that exciting. And then I've called this other company in grey, which I've called Euphorium Group for want of a better term, loss making up front, but it's got euphoric growth prospects, way out in time. Whether or not the basis for these forecasts is accurate or not is another matter entirely. But the point I want to make here is, if we go from the undiscounted cash flows into what I think is sort of a normal discount rate to apply to most companies of around 10%, you apply that 10% discount rate to your undiscounted cash flows. This is what happens here. These cash flows way out in time get heavily discounted, and the sum of all those cash flows, now you see Euphorium Group being valued at slightly less than half of Franks and Beans and Franks Limited. All right, so that was the case up until say 2000 and 2010 or thereabouts. But over time, the Fed has continued to cut rates. Inflation has been non-existent. The cost of debt has also been decreasing. So as your risk-free rate and your cost of debt both decrease, so does the discount rate that you apply to future cash flows. So if you drop that from 10% to 6.4%, and then all of a sudden, these cash flows way out in time start to look a little bit better. And then if you drop it again to sort of circa 4%, all of a sudden, this company, which is loss making, but their longer term cash flow projections aren't discounted as much. All of a sudden now, this Euphorium Group is worth about 20% more than your profitable industrial. And in that way, what has happened over the last 10 to 12 years is a bird in the hand is now only worth 80% of one in the bush, or in terms of, viewed in terms of cash flow generation. So this is what has been happened, but now the worm is starting to turn, which is why on that previous chart, the rise of unprofitable companies, I think is looking a little bit wobbly. And it is fair to say that, there's a lot of resource companies or commodity companies out there which aren't profitable either. But as I said, they do have exposure to a hard asset class, and in an environment of rising rates and even rising inflation, those companies should do better than the rest. But whilst that's sort of just a highlight of the risk, I think also just as important is to have a look at the driver of some of this euphoria in the markets at the moment, and that primarily is all driven around upside surprise in the vaccine rollout, which is occurring globally. These charts I put together for a presentation 2 weeks ago, and already they're already out of date. The US is running at about 2.3 million vaccinations per day, which is about 12 or 13% above their targeted rate. And even maybe a month or so ago, people didn't think their targeted rate was achievable. So they've really surprised on the upside there. The UK is also surprising on the upside as far as their vaccine rollout's going. And obviously Israel's leading the way. I mean, they're almost done, and they've seen infections in that country drop off a cliff. And you're seeing similar downturns in the US and in the UK. then on top of that, as more and more people get the vaccine, people's perception towards the vaccine is improving. So, we've gone from, roughly 13% of people saying that they'd get the vaccine straight away back in September of last year, and that's risen to 43%, more recently. There is a rump of people in the US. I think it's roughly 25% who, they haven't changed their view. They're still reluctant to get the vaccine at all. Mostly Republicans, funnily enough. But even still, you get to 75% of the population vaccinated, you're going to start approaching herd immunity, and the opening up of the economy is almost assured. So that's what's happening in pretty much right throughout the Western world, more or less at the same time. And the outcome of that is going to be synchronized global growth, something we haven't seen really since sort of 2007, 2008, and then in the wake of the GFC. So that is a very positive demand thematic for commodities, or demand for thematic in general, but particularly for commodities. But there is a little bit more to it than that, because COVID wasn't like the GFC, and particularly in terms of the level of debt that people are carrying. So what we've got on the chart on the left here is, these red bars are periods of recession within the US. And then this white line is United States household debt divided by personal income. So as you no doubt most of you recall, heading into the GFC, everybody was up to their eyeballs in debt. We had a big global slowdown, and then we had to go, and then everybody went through a painful de-gearing process. So if you're de-gearing, you're not, you're saving, you're not buying anything. Consumption was woeful, and so the economic recovery post GFC was extraordinarily long and painful, despite multiple stimulus efforts to get the economy back on track again. Now you compare that to the COVID dip, which is much shorter and sharper than the GFC, and deeper on many measures. But because we've had this massive wave of financial support, right around the Western world, and there's more of it still coming, personal balance sheets are actually in very good shape. So you're not going to have a period of de-gearing when the world opens back up again. People's personal balance sheets are looking the best they've done in years. And so we're going to have this opening up and wave of euphoria associated with people that are long cash and looking to spend. So, I think the, GDP growth targets globally are being upgraded, time and time again for calendar 21, and I think they're going to continue to surprise on the upside, because people have money and they're willing to, and they want to go and spend it. And so, what that lends the question: what are they going to spend it on? Well, in short, everything. But one of those things is going to be new cars. And this electric vehicle revolution, I think, is be fair to call it, is starting to go exponential. So we've got a number of forecasts here on what proportion of EV sales, or what the proportion of EV sales will be of total sales. Goldman Sachs, PwC, Navigant, which is sort of an industry think tank, they've all been wrong. The actuals are surprising to the upside quite materially. And that's going, and so that should continue to accelerate as the range of EV vehicles on offer continues to expand. And there's been many charts on this thematic, but one of my favorite ones is by Romotion, which highlights the expenditure by all the major car companies you've seen over the last 5 years, and summing to $500 billion on their their EV investments by broadening their range and research and development efforts to meet or to move into this sector. So I think it's not a big call to say that we're past critical mass here. I think when I gave this presentation 2 weeks ago, it was GM Motors that had just recently came out and said their full fleet will be won't have any internal combustion engines in it by 2035. Volvo's said the same thing earlier this week, and they joined Volkswagen and a few of the other big guys who are are also heading down that path, because if you haven't had a drive an electric vehicle yet, I mean, I really do recommend it. It is something to behold. So along with the range of vehicles expanding, the price is also coming down. We've seen that with the Tesla Model 3. Prices are being dropped as they achieve greater economies of scale. So this is a new, very commodity intensive toy that is going to be rolled out around the world, and also the infrastructure that supports these EVs is also going to have to be upgraded, because there's circa 90 million barrels a day of oil, which is that is being converted into energy at the moment. That's going to have to start running through grids and copper networks over the next 5-10 years and beyond, and that's going to require a lot of metals to upgrade that. This is a longer term demand thematic, and it will need more mine investment to meet this. So Wood Mackenzie put a figure on it in late last year of roughly $1 trillion of new mine investment, which will be required to meet their forecast demand by 2035. So that's a medium to long term thematic or demand that tailwind is going to have to play out. But in the shorter term, what's exercising my mind is the inventory situation. So base metal inventories, generally speaking, are pretty depleted. Copper's probably looking the more acute out of all of them, and we see the copper LME inventories there, and these charts get rolled out quite often, and it's reasonably well known. But what's exercising my mind in the short term, and probably giving me a bit of comfort that copper as a commodity will get through any dip in, caused by a sort of a dot-com-esque sell down, is the inventories of end products. So these two charts on the right here, US consumer inventories are at very depressed levels. Auto inventories also at very depressed levels. And this is a function of COVID once again. So, going into COVID, there was a buyer's strike. All the stockists, let go of their stock and didn't order anymore. The manufacturers themselves slowed down production because all of a sudden demand dried up. Also, they had to shut down production in a lot of cases because COVID was, making operation difficult or impossible. But as demand has come back much quicker than people expected, 6 or 9 months ago, the manufacturers haven't been able to ramp up as quickly as demand has recovered. And this is a very similar situation to what we saw in the US steel industry from circa 2016-17 into 2018. Steel prices went through a period of being very depressed. Steel traders destocked because no one wants to hold inventory in a falling price environment. But when demand turned and came back, it took about 18 months for the steel mills not only to catch up and meet demand, there was also a restocking demand which they had to meet as well, and it took them a very long time to fulfill those two factors. And this is exactly what I see sitting in front of me at the moment, is that these end products of everything from air conditioners to cars to fridges to personal electronics, they're all depleted. So there is a restocking demand which is going to go over and above, which sits on top of sort of retail demand, which, as per those previous slides, I'm expecting to come back very strong. So, as a short-term thematic, I think this should keep the base metals very well supported, through any market volatility that we see in the equity space. Moving to the longer term now, and at where this new mine supply is going to come from, well, the mining industry is standing very much flat-footed. I mean, once again, looking through the copper lens, this is a chart from Glencore's recent half-year result, which shows the copper mine project pipeline. So the sum of highly likely projects as forecast from 2019. So just a bit of background to this, like through the either side of the GFC period, a wave of base metal euphoria. The money was being thrown at projects left, right, and centre, and so we had this big uptick of planned capacity additions of copper production, and then over time, those all those mines were brought online, and so the pipeline of new projects is looking very depleted, and it's going to take some time for this to be backfilled, because whilst copper price is quite high at the moment, you've got now a range of probably tightened environmental regulations, local community objections to mining, and the mining industry as a whole is being put under a much more tightly focused microscope in their behaviour, and so the ability for supply to respond, I think, is going to be hampered by that, as well as the fact that you need to go and find these projects first. So, I mean, to give some granularity on this, just recently we've seen Mongolia tear up the agreement with Rio Tinto about Oyu Tolgoi. That needs to be renegotiated, and there's question marks on how long that big lump of new supply will be until it gets to market. Both BHP and Rio have had their extension of the Kennecott Utah copper project deferred by the Biden administration. There's some First Nations groups neighbouring that which have objected to it. It was approved under Trump, but now it's being placed back under review. So, all these impediments to supply coming on are popping up, and there's more coming in Zambia, where the government wants to take a greater share of copper revenue. So those projects have been put on the go slow, and I think Glencore has sold down one recently there. So it's complicated to see where this wave of new supply is coming from, and what makes longer term thematic even more compelling is when you look at the rate of supply required versus what happened over the last 10 years. So once again, from Glencore, and it's a mining company, so perhaps a little bit self-serving. So you need to keep that in context when you're reading through the fine print here. But the fine print is quite compelling. So, from 2010 to 2019, the growth rate required, or growth rate achieved in copper production, was about 500,000 tonnes a year, whereas the growth rate required to meet 2050 demand forecasts, and these forecasts are created under the 1.5 degree scenario, which has been put together by the IEA and others. That's going to require up to 1 million tonnes of new copper production each year to meet that future demand. Now, 1 million tonnes of copper, for context, the largest copper mine in the world is Escondida. That does about 1.3 million tonnes per annum. And then after that, there's Daylight to second place, which I think is Grasberg, which does around about 500,000 to 600,000 tonnes per annum. And these are very unique sort of one-off type projects. I mean, more than likely, it's quite difficult to find a copper project which will do over 200,000 tonnes, get it permitted, and get it into production. So, this is a real challenge which the industry is facing. So whilst all that sounds very good for the base metal markets and copper in particular, I think it is. I have to spend a little bit of time looking on gold, because it is a big part of the ASX mining sector, and it is looking pretty dreary at the moment. So all this outlook that I've just described, synchronized global growth, that doesn't equal uncertainty, and usually the uncertainty is, or macroeconomic uncertainty is, what the gold price needs to do well. I mean, these charts are a little bit old. Once again, I put up a couple of weeks ago, but what we were seeing at the beginning of this year was the gold price to front run a increase in real rates. And when I say increase, just keep in mind this axis over here is inverted. So I mean real rates becoming less negative, and they have ticked down over the last couple of weeks. And that's because the market is expecting the Fed and other central banks to bring forward their forecasts of rising rates. Now, to combat the tick up in yields we've seen over the last couple of weeks, the Fed came out, I think that was last week, and said, "Oh, no, we're going to keep rates, anchored at current levels for the foreseeable future." The RBA came out and said basically the same thing. I think personally, the RBA was more trying to jawbone down the currency than anything else, but you can't fight the market, and if the global economic pickup accelerates at the rate which a lot of market participants think it will, that means rates are going to probably have to come up higher than what the central banks around the world are saying at the moment. So that means real rates will continue to become less negative, and that's bearish for the gold price. So it's falling at the moment. What's going to be the bottom in gold? Like, what am I looking for? For me, I think it's when when the central banks start to lose control is when gold does well. So, and that happens at either end of the inflation spectrum. So if we see inflation do start to take hold a little bit, say if the central banks don't blink and they hold rates low and they keep rates down, well, yeah, I think that could be when gold bottoms and starts to think about rallying. And then if we start to see inflation start to rally away from where nominal rates are being held, that'll mean that real rates once again start to be turning negative. And I think that's where gold does start to do well. And then the question is not so much of the economic recovery, it's, well, how do the central banks manage their own balance sheets and cost of debt in an inflationary environment, and I think that's what a lot of people were looking for, in terms of gold price exposure a couple of months ago. But we just need to get through this period of economic recovery before we get there. So that's view on the metals in a nutshell. I just thought worth touching on the the funds management industry for a little while. No, sorry, hang on, what's my slides got stuck? There, oh, sorry, next slide, what's going on? There we go. So yeah, a word on funds management. The Perennial, smaller companies, I suppose, before I get into our little world of funds management, I think it's the boutique funds management industry has been much maligned over the last 5 years. At the behest of the industry funds, the advertising campaign that those guys have run has been very, very effective. And the ads that I'm talking about, I'm sure you've all seen. There's Adam and Barry sitting on a park bench. One of them has their money in a industry super fund. One of them has it in a retail fund. Same income, same cash balance, and obviously the industry fund guy always does better. And we've been at the butt of that, and we've seen particularly in the larger cap space, seen quite there's been outflows right across the sector. But if I got those numbers from the ad and just work backwards to see what sort of fee differential they were talking about, you can get the same outcome with about a sort of a 0.9 to 1.2% difference in fees, depending on whether you extrapolate over 15 or 20 years and what sort of income that you assume along the way. So, but it's somewhere within that ballpark. But if you get your phone out after this presentation and Google what is the best performing super fund, you scroll through a few results, you're going to get a list of funds which aren't necessarily the best, but they're certainly the biggest. And the returns that you'll be seeing there over 5 years averaged are around the sort of 5 to 6% range. I mean, and that compares with what we've done over the last 5 years in our small cap fund of 15.5%. So, to get back to my point, it's your return net of all fees, which is all important. And, as you can see between that example, like you're not talking about, when you're talking about net return after all fees, it's not a 0.9 to 1.2% difference. I mean, the difference can be quite material. And if you extrapolate that over, 15 or 20 years, it's not a couple of $100,000 difference. It can get up into the millions. So, with that in mind, and obviously this is a mining focused call, I would like to get to the Global Resources Trust, which is what the fund that I've been running and what I'm heavily invested in. We've had a very good year, 97% net of all fees up until the end of January. I think that was. I think February was reasonably flat. We're up sort of 0.5% or something like that. But still, the portfolio has been rotated materially from when we started. The list of stock exposures and commodity exposures has changed materially. We've pivoted away. We started off with a heavy exposure to gold of up to 30%. That's down to circa 7% of the portfolio now. Exposures to base metals and new energy metals has gone up materially for all the reasons that I've just explained. But certainly, I think a bit of short-term volatility aside, with the tailwinds of recovering global demand, a commodity-intensive emergent sector in terms of EVs and new energy metals and renewable energy in general, I think this sector will continue to do quite well, and certainly. Some of the re-ratings that you see from these well-established, sort of well-drilled out and established projects as they move into production and get over their capex hurdles, I think have been quite spectacular and will continue to do so, or will continue to be so. So with that all in mind, I think I'll pause for a second there and start to open it up to questions.
Great, thanks very much, Sam. We do have a few questions. Whoops, I've just maximised that and lost everything. 1 second. We do have a few questions that have come through, and I've also got a couple myself, particularly that one around copper. We were talking about the year-on-year growth expected for copper based on the predicted demand for electric vehicles. What happens when production costs become excessive for copper? And, is there things that come in behind that either electric vehicles, hydrogen's always been there, but same issues around infrastructure to, recharge or refill. Is there any thoughts on that?
Yeah, so some of the bare points that gets lost in the euphoria. There is a point between copper and aluminium where substitution starts to become compelling. I was just trying to think off the top of my head. I think it's around 3.5 times price, which is sort of where we are at the moment. So historically, once you get to that differential, you start to get price-induced demand destruction in copper, and some of that switches to aluminium, but you can't make that switch across all applications, and certainly a lot of the ones that are EV focused, aluminium is not satisfactory. It just doesn't have the same conductive capacity as what copper does. So, it once again, it lends itself to a sort of a structural, positive structural outlook for the metal. Also, yeah, as prices move up, the miners will be all of a sudden, previously uneconomic projects will become economic. They will get funded and move into production. So that the supply response will come, but it's very slow. And if you've got a whole gamut of more onerous permitting hurdles to get through on the way, then yeah, it just becomes harder still.
Yeah, and that's actually one of the other questions we've got here touches on that, where you're talking about copper and base metals as part of the EV theme. What are the other niche minerals which have been put here as lithium, graphite, and high purity alumina? What of those do you actually think presents the best opportunity?
It's in the short term. A lot of the lithium equities have run reasonably hard, but I think there's still more to go in that space. The spodumene price, I think, has only just crept up, towards $500 a ton. That's companies still aren't making great margins at that space, and because it is such a boutique, such a small market in terms of tonnage, the prices have got scope to move a little bit higher. But I think what separates the sort of the wheat from the chaff in terms of longer term sort of thematics that you can invest in is just looking about where the supplies can come from. So in lithium, yes, demand is ticking up very strongly, but lithium is a very common mineral, and there's a bucket load of new projects and new capacity and idled capacity that can restart and meet that demand as prices allow. Cobalt's not so easy. So a lot of that cobalt's coming out of the DRC. There's problems with sort of expanding production there, and even sort of the European or US vehicle manufacturers are wary about accepting cobalt out of the DRC because the way in which it's mined is it can be pretty rough on the miners themselves, to put it lightly. So that's of interest. I mean, high purity alumina is looking compelling at the moment, but once again, it is a very small market. So there will be a reasonably small window where one or two producers will get into production and they'll do very well. But it's not like iron ore where a new mine might add 1.5% to global supply. I mean, compared to sort of compare that to lithium, where a new project might bring on 5 or 6% of global supply, and high purity alumina is probably higher again. So there's a window there, but it's probably not as long as structurally supported by constrained supply as opposed to copper. I mean, rare earths is another one which there's a new projects. There's a new project pipeline building, but the technical hurdles to bring rare earth projects online are onerous, and anybody who was around watching the problems that Lynas had try to get its project into production will know it's not so easy. So I think that those that sort of technical expertise could delay the supply response for rare earths for a fair while as well.
One of the other questions here, which is one that I had as well, 30% approximately of your portfolio is in mining services. Can you shed some light on the themes that you are exposed to here?
Yeah, it's a good question. I do get that question a lot. So within that 30%, there's a decent tranche of that, probably 10 to 15%, and it is growing. That is more new mining tech rather than your stock standard mining services. So, for example, there'd be companies in there like DUG, DUG, which is a high precision compute, high performance compute firm. So they traditionally service the oil and gas industry, and they which uses HPC for processing seismic data, but their cost of processing power, or cost of compute, or cost of supply, is materially lower than their peers due to a patented sort of heat exchange technology, which allows them to sit their hard drives in baths of oil. So as a result, you don't need those big air-conditioned warehouses that you constantly see in sort of snapshots of these big data centers and whatnot, which all have to be temperature controlled because these hard drives throw off a lot of heat. By sitting them in oil and then allowing the oil to cool via convection, their cost of operating are materially less. And this is a market which is growing at circa 25 to 30% CAGR, and is forecast to be $1 trillion market by 2030. So, yes, the oil and gas services, that's within the remit, but there's a new technology element there which I don't think is as exposed to the how cyclical the commodities market can be. And so companies like that, SRJ be another one, which is this new pipe fitting technology which doesn't require welding. Once again, oil and gas services facing. Is one or two pre-IPOs in there as well, which are looking at the sort of new LiDAR technology, which a lot of the mining fleet are using on their the mining industry are using on their haul trucks as a means of automating their mining sector. And yeah, sure, it's not purely focused on mining, but the the mining sector is leading the adoption or leading the way in the adoption of a lot of these technologies. So, you know, I go out to the mines and I see this stuff, and I get a good look at it, and I suppose that's the granularity of it, along with we do have some I suppose earth moving exposures in there as well, which are just plain cheap. So the reason all that's in there is because a lot of these companies have solid earnings. They're trading on very cheap multiples. I often get a look at their operations ahead of others in the market, because I do a huge number of mine site visits each year, and have I think have a bit of advantage there. So, and I think from a portfolio construction point of view, like this is an absolute return portfolio. So it's good to have some of these exposures in there with hard earnings, and probably add a bit of a defensive element to to some of these other direct commodity exposures, which can be quite volatile in particularly when the markets market sells off. So yeah, that's the pulling a few pieces of that answer together.
Yep. And one other question that starts with congratulations on a great first 11 months and the nearly doubling of the unit price so far. What themes or stocks have been the biggest contributors to that performance?
There's been quite a range. So outside of Siren Gold, which was a pre-IPO investment, and I think that attribution from that, I'd be about sort of 4%, I suppose, out of the 97. That's been the biggest. Below that, the next biggest is around 2.5, and then comes down from there. So the attribution has been quite evenly spread. I mean, Siren Gold, there was a very well priced pre-IPO investment in a euphoric gold environment. Unfortunately, because the pre-IPO investment was at a decent discount to the IPO price, I was subject to escrow for 12 months. So, whilst we did let a little bit go at higher prices, we've been stuck with it in the portfolio now. So it has cost us a little bit in Feb, and probably dampened the result, through that month, which would have been a bit better otherwise. But looking forward, I mean, some of these copper developers, I think the better ones look really good for all the explanations we've seen here. So just recently, we've participated in a placement of KGL, which has got a permitted, it looks like economically viable project in the Northern Territory, very tight register. But whilst there is a core asset there, which looked like fair value at the point of investment, the exploration upside around that project is very, very compelling. Now, exploration upside is something that we will not pay for in its own right, but we do like the free option of exploration success, which is what we think we're getting with that one. It's been almost privately funded up until just recently. And so a lot of these exploration targets, which are very low-hanging fruit and have confirmed mineralization present, it just hasn't been drilled around. That looks pretty good. And so there's a range of those guys. Some of the high purity alumina producers, I think, are moving quite quickly. So I mean, A4N and FYI Resources, we've got exposures to both of those. And then I think there's still some re-rating to be had in the lithium space from, as some of these companies which, exposures to very large resources, particularly if they're domiciled in the US. I think that's, this wanton need for domestic production from some of these critical elements should see some of these stocks, continue to re-rate pretty well. So, that's where I'm looking and leaning at the moment.
Okay, thank you. That's, I think, just gone on our 45 minutes, which has been really good timing. Is there anything else, Sam, that you want to close with before I close the session?
No, I just like to thank Lucerne again for its support. People listening, I'll be investing more in this fund, once my dividend from last year comes in. So I'm still quite comfortable with the space. I'm comfortable with the exposures that we've got. And, whilst I can't guarantee a next 12 months like the previous 12 months, I think that the space is structurally inefficient, and any investment approach in its essence is trying to exploit some sort of inefficiency in a market, whether that be a quant or whether that be some other fund, and I'm trying to exploit I suppose a poorly understood sector more broadly, whilst a lot of new money is coming into it. So hopefully that means that we can continue to generate positive absolute returns through the sector for a while yet.
Terrific. Thanks, Sam. I'd just like to close the session. Thanks, Sam, for his presentation, and congratulate him and the fund on the performance over the last 12 months. Thank everybody for attending. I hope you found it as interesting, and in particular the sector and the underlying themes that Sam spoke about as we do. One of the things I'd like to just touch on, Sam mentioned about niche and boutique fund managers earlier, and that's something that we at Lucerne, and also through our Lucerne Alternative Investments Fund, have always been looking for, and we continue to find in different sectors, not just commodities, but other areas as well, private debt, private equity, all through to other smaller micro cap and new opportunities. And we're always identifying them. There's a couple right now that we're reviewing that will become available for investors either through the fund or directly. In addition, I just thought it'd be probably worthwhile mentioning that Anthony Murphy, Lucerne's CEO, has published a couple of articles on how to find good fund managers and what we look for, and the reasons we continue to look for that outside the mainstream. If you want a copy of those articles, let us know and we can make them available to you. And other than that, I'll leave it there and thank everybody for coming, and until the next one. Thanks very much, Sam.
Thanks very much, Mark. Pleasure. Thank you.